us in the series that we have on business combinations, disclosure, goodwill and impairment. As you will imagine, each of these webinars have a different focus, and our focus today is on investors. What are the views of investors? We have assembled an important series of users for you, starting with Nick Anderson of the IASB board, who will give the IASB presentation. Then Chiara will come in, and then we have with the EFRAG views, and then we have the panel of users moderated by Hans Buysse, EFRAG Board Vice President and Chairman of ABAF, BVFA and EFFAS board member. So this is a joint webinar together with EFFAS, ABAF, BVFA. You will see that on your screen you will have the polling questions, so we want you to fill in those polling questions. There will be 2 now at the beginning, and then later on there will be additional questions during the panel discussion. We also have the possibility to ask questions, and that you just have to type in and they will be picked up. So I'm now handing over to Nick Anderson from the IASB board, and I will ask you to complete the polling questions. The board is for you.
So good afternoon, everyone, and thank you for joining us today at this event. I'm going to give you an overview of our discussion paper, Business Combinations, Disclosures, Goodwill and Impairment, which the board published in March this year. Slide 5 provides an overview of the board's project on goodwill and impairment. However, the discussion paper is not just about goodwill. It also deals with improvements to disclosures that companies provide about M&A. Now, the board started this project after a review of its standard that deals with M&A, IFRS 3. The objective of this project is to improve the information that companies provide to investors at a reasonable cost about businesses that those companies buy, helping investors hold management to account for acquisition decisions. Although we're at an early stage in the board's process, it's important that we hear what people think about the board's ideas, especially what investors think about the new disclosures. This is also an opportunity to explain what you think about whether goodwill should be amortized or not. So the deadline for submitting comment letters is the end of this year, 31st of December. Slide 6 summarizes the board's views that are presented in the discussion paper in response to the feedback the board's heard in the post-implementation review of IFRS 3. These cover 3 main areas. The first relates to disclosures. The board is proposing to require companies to disclose information about how M&A transactions perform after the acquisition. It's also proposing to make some improvements to current disclosure requirements about M&A. The second area relates to improving the accounting for goodwill. The board explored whether it could make the impairment test more effective. It then considered whether to propose reintroducing amortization. Finally, the board explored some potential simplifications to reduce the cost of performing the test. The third and final area relates to some other topics. Excuse me. The board thinks it should require companies to present total equity excluding goodwill on the balance sheet. The board also thinks it should retain the current approach of requiring companies to recognise identifiable intangible assets separately upon acquisition, rather than subsume some of these intangible assets into goodwill. The views in the discussion paper are initial views. Depending on the feedback and the comments the board receives from outreach and from comment letters, the board may decide to reconsider some or all of these views. So let's now take a look at each of the 3 areas in more detail, starting with the disclosures on slide 8. One of the key messages the board heard from investors is that companies generally do not disclose sufficient information to allow investors to assess how well an acquisition has performed post-acquisition. Investors want this information to hold management to account for their decisions to acquire those businesses. Most investors told us that this information is needed for stewardship purposes to help them, for example, determine whether they can trust management with future capital. Existing standards do not specifically require companies to disclose such information. any information that is provided is disclosed voluntarily. Therefore, the discussion paper explores whether to require companies to disclose information on the subsequent performance of acquisitions. The board thinks it should require companies to disclose three things in the year of acquisition. First of all, the strategic rationale for the acquisition. Now, this rationale would be a high-level statement that links the acquisition to the company's overall strategy. Secondly, the key objectives of the acquisition, these being more detailed aims that management intends to achieve as a result of that acquisition. And thirdly, the metrics and targets that management will use to assess to what extent those objectives are being achieved. In subsequent periods, the company would disclose the acquisition's actual performance based on those metrics to enable investors to assess to what extent the key objectives identified at the acquisition date are being achieved. So what kind of information would companies need to disclose in the subsequent years? Slide 9 looks at this question. Now, there are a wide range of types of M&A transactions serving many different purposes. And as a result, the board concluded that there is no single metric that would be suitable for every deal. Therefore, the board's exploring a management approach. In other words, the metrics disclosed would be those that a company's management uses internally in monitoring the achievement of the objectives. These measures could be operational or financial or a mixture of both. Now, because M&A can quite often involve large deployment of capital and a high level of execution and integration risk, the board presumes that companies are monitoring their major acquisitions. If management is not monitoring an acquisition, the board believes the company should disclose that fact rather than the board prescribe a minimum set of information to be disclosed. By management, we mean the company's chief operating decision maker. This is the term that's used to identify the disclosures required in segment reporting and is the person or functions, it could be a board for instance, that is responsible for allocating resources and assessing the performance of the operating segments of a company. The board assumes that the chief operating decision maker is reviewing the information that is critical to the success of most acquisitions. Using the CODM in this way is a practical solution that means companies disclose the most important information about the most important acquisitions. A lower threshold might result in excessive and costly disclosures, particularly for companies that make many acquisitions. The board would like feedback on whether using the chief operating decision maker as a threshold would lead companies to disclosing all the material information that investors need about acquisitions that they want to know about. And for the remainder of this webinar, we'll simply refer to management rather than CODM. So how long would companies need to disclose this information? The board thinks that companies should continue to provide the information for as long as management continues to monitor the acquisition date objectives. The board appreciates that information about the subsequent performance of an acquisition can become less relevant over time, and eventually the acquired business becomes indistinguishable from the rest of the business as integration occurs. Nevertheless, the board expects management to be aware of how well an acquisition is performing for at least the first few years, and therefore expects companies to provide this information for at least a year of the acquisition and the 2 subsequent annual periods. If a company stops monitoring the acquisition during this time frame, it would need to disclose the reason for doing so. Now, there have been various concerns raised about providing this information. For example, what if an acquired business is integrated into existing business post-acquisition? This answer depends on how management is monitoring the success of the acquisition. The principle here is to disclose the information that management uses internally to monitor acquisitions. That might be information about the combined business. The board is not expecting companies to satisfy these requirements to disclose the information management are already using themselves. The discussion paper reflects other concerns the board has heard, including whether this information is commercially sensitive and whether it's verifiable. The board thinks that commercially sensitivity is not a sufficient reason not to disclose the information that investors need. Some investors told the board that companies provide information about objectives at the time of the acquisition, at investor days, or in press releases. And investors are simply looking for companies to provide a follow-up to this information, which presumably isn't that companies were willing to provide this information in earlier material. So investor views of whether they need information about the subsequent performance of acquisitions and whether they think that the board's approach will provide useful information will be very important for the board as it decides how and whether to implement these ideas. The board's preliminary views also include some targeted improvements to existing disclosures in IFRS 3, which are summarized in slide 10. And these include disclosure of quantitative information about expected synergies, information about defined pension liabilities and debt assumed with an acquisition. Investors consider this to be part of the capital employed in a transaction, and some changes to the actual and pro forma information disclosed about the acquiree. Make it clear the profit or loss number disclosed should be operating profit or loss, and adding in a requirement to disclose operating cash flows. Turning to slide 12, the second area addressed by the discussion paper is the subsequent accounting for goodwill. The feedback about the impairment test was that the impairment losses are recognised too late. Investors have often reacted to reductions in their valuations long before impairment losses are recognised by companies, but also that the impairment test is costly and complex. The impairment test is not a direct test of goodwill. Goodwill does not generate cash flows on its own. It can only generate cash flows in combinations with groups of other assets, and so it can only be tested for impairment alongside other assets. Hence, the test is an indirect test. The unit of account is a group of assets being tested. The board explored whether it could make the test more effective at recognising impairment losses on acquired goodwill on a more timely basis. So the board identified two possible reasons for the too late issue: cash flow forecasts that are too optimistic and what we call shielding. On the first issue, the board's standard on impairment testing requires management to use forecasts that are reasonable and supportable, and to disclose information about the assumptions used to provide investors with information about the reliability of impairment tests. The board's view is that if forecasts are too optimistic, this is an implementation issue best dealt with by auditors and regulators rather than by standard setting. The next slide, slide 13, illustrates how shielding can contribute to the too late issue. What this means is that when an acquired business is integrated into an existing operation and they are tested together for the impairment test, items such as unrecognised intangibles in the existing business can shield the goodwill from impairment, even when the acquired business is not performing as expected. Moving on to slide 14, to try and fix, in part, the too late issues, the board looked at an approach to reduce the shielding effect, but concluded that it was not feasible to design a different impairment test that is significantly more effective than the current test at a reasonable cost. Now, the board accepts the test isn't perfect. The test will not always provide a signal of how well an acquisition is performing, but this does not mean that the test has failed, as some people say. And although cash flow forecasts will always be judgmental, applied well, the test should meet the objective of ensuring the book value of the group of assets being tested as a whole is recoverable. Furthermore, providing information about the subsequent performance of an acquisition should provide better information about the performance of that acquisition. During the review of IFRS 3, the board also heard some feedback it should reconsider the amortization of goodwill. Slide 15 lists some of the arguments for amortization, which would be amortization plus impairment, of course, and some of the arguments for an amortization or an impairment-only model. The discussion paper contains a fuller discussion of the arguments of both approaches. Now, I'm not going to go through all of these, but let me just pick out a few that are most relevant for investors. Some investors, especially equity investors, have told us that an impairment-only approach provides more useful information. Albeit in some cases, this may only be confirmatory information rather than new information. They say that impairments help in holding management to account because it acts as a stamp in the financial statements that gives a record of management's ability to successfully identify, acquire, and integrate targets. Some investors say that goodwill is not a wasting asset with a finite useful life, and therefore any amortization would be arbitrary. Therefore, they say that the amortization expense would always be added back to a company's profit during a reporting period. In that respect, an amortization charge provides no useful information value. Some go further and say that management may try to compare profits excluding goodwill amortization to a reduced net asset number, thereby artificially inflating the return on assets, making it harder to hold management to account. On the other hand, some say the impairment test is not as effective as the board hoped, and that impairment losses are recognised too late. This reduces the ability of investors to hold management to account for acquisition decisions. Some say an amortization charge would help to hold management to account, reporting companies as profitable only if they generate enough profit to cover that expense. Some argue that goodwill is a wasting asset consumed over time, and that amortization is the only way to show the consumption of that asset. And it's right that the amount of goodwill should be reduced on a company's balance sheet to zero over time. We also heard some other suggestions from investors, including that goodwill provides no useful information, regardless of whether it's amortized or subject only to an impairment test, whereas others say goodwill should be kept permanently on the balance sheet to provide a record of the capital a company has deployed and the return it needs to generate against that capital. The board's view is that it should retain the impairment-only approach. And this is by a narrow majority. However, the majority view is that there's no compelling evidence that changing back to an amortization model would be a significant improvement. This isn't simply about which model is better. It's about whether there is compelling evidence that change is needed. Repeating well-known arguments will not move the debate forward. Instead, the board welcomes feedback that provides new evidence or new arguments, or perhaps reasons why previous arguments are now more relevant. Investors' views on the usefulness of different approaches will be an important factor in this debate. In response to the feedback that the impairment test is costly and complex, the board considered whether there were other ways of reducing the cost of performing the test without significantly impacting its robustness, and this is discussed in slide 17. One of the reasons given by companies for the cost of the test is the requirement to perform the test even when there's no indication of impairment. The board proposes in the discussion paper that it should remove the requirement to perform a quantitative test annually. However, companies would still need to assess at each reporting date whether there was significant indication of impairment. And if such an indication exists, a company would then have to perform the quantitative test. The board's majority was narrow on this issue, but overall, the majority of members considered that the reduction in the cost would be would be significant, and the reduction in the robustness of the test would be marginal. So performing the test when there is no indicator of impairment is unlikely to identify a material impairment. One thing for investors to consider in relation to this is the availability of disclosures about the assumptions that management use in the impairment test. For example, assumptions about growth and discount rates. If a company isn't performing the test in a particular year, it won't have this information available to disclose to investors. Some investors say this information is useful, and so we'd be interested in hearing your views about this. The board is also considering some simplifications to the value in use test. There are two more topics in the discussion paper that I'd like to briefly touch upon, and these are shown on slide 19. Firstly, the board's view is that companies should present on their balance sheets the amount of total equity excluding goodwill. The board's view is that such an amount could be a useful flag to investors to highlight those companies where goodwill is a significant proportion and sometimes more than their total equity. The board is also considering whether the companies should subsume some intangible assets within goodwill and not recognise them separately in a business combination. And here the board has heard some mixed feedback. Some say that recognising all identifiable intangible assets acquired in a business combination separately from goodwill provides useful information. But others question that information. For example, they say some of the assets are difficult to value, and others say distinguishing such intangible assets is complex and subjective. At this stage, the board's view is that there is no compelling evidence to change the recognition criteria for identifiable intangible assets in a business combination, given the mixed feedback that it's heard. Slide 20 finally summarises the board's view and how these line up against the project's objectives. The board considers its views as a package of interconnected measures. I think it's on the next slide. Here we go. That together will provide better information to investors on acquisitions and help hold management to account for those acquisition decisions. At the same time, the measures will provide some cost release to preparers. So overall, there's a reasonable balance here between both costs and benefits. Thank you.
Okay, thank you, Nick. Then we are now going over to Chiara to present the EFRAG positions. Chiara?
Thank you, Saskia. Thank you, Nick, for this illustration. Let me just give you an introductory remark on how important goodwill is in EFRAG work and has been also in the past. We issued a research, different pieces of research between 2015 and 2015-2018, before the IASB started this project. And we are also pleased to see that this DP has also taken on board some of our proposals. Can we go to the next slide, please? We issued our draft comment letter. This means that the views that I'm about next slide, please, that I'm about to share with you are still preliminary, subject to changes once we have heard back from this outreach program, including, of course, today, and the comment letters that we welcome until the end of November. In general, we support the objectives of the discussion paper, and we agree that there is a problem with the information that users currently get on the goodwill and how the business combination has performed after the acquisition. Therefore, we support the proposed disclosure. However, we consider that also the accounting problem deserves some more attempts to find a solution. Nick illustrated very well the issue of the shielding effect, which is somehow due to the construct of how the business is tested today. So what we have tried in our comment letter is to identify some additional changes that the IASB could consider to enhance how the test is performed in practice. And I will come to you in a minute to better illustrate what do we mean with this. So in our draft comment letter, we are also consulting in a number of on a number of issues, and several of these questions are also addressed to users, so we would welcome very much your input on that. Next slide, please. So on the proposals of the IASB to improve the disclosure about business combination, we agree with the approach taken by the board to go for a disclosure that provides the views of the management and the KPIs used by the management, and we agree with the contents of the proposed disclosure. However, as I was saying in my opening remark, we regret that these disclosures are not linked to the recoverability of the goodwill, are somehow detached from the accounting problem. So we are inviting the IASB to consider the information also as a possible way to trigger the impairment test or elsewhere to link the disclosures also to the recoverability of the remaining book value of goodwill. In our preliminary views, we also question whether the CODM is the right level. We understand from talking to users that this level may not provide always the good level of granularity. And we would be curious to know your views on these. And this is also linked to the opinion that users have on how IFRS 8, which is based on the same concept, is working so far. We also have a number of questions about the practicability of this proposed disclosure on auditability and reliability, because of their forward-looking nature. And for this reason, some of our members think that these disclosures should be better placed in the management commentary instead of the financial statement. We also suggested to require the disclosure for a longer period than only 2 years. And we also question the usefulness of the pro forma information on cash flows from operating activities. So more question about, I would say, the cost balance sheet, the cost-benefit balance. Can we go to the next slide, please? Yes, so these are questions that we raise in our consultation. Commercial sensitiveness. We know that there will be a trade-off to be achieved between users' need and preparers' reluctancy to disclose this type of information. As I already said, we are inquiring about the cost, the reliability, the constraints that may exist in providing this information. And I would say these are the main points where we are consulting. Next slide, please. The second big topic is about goodwill accounting. So how to enhance the current model, whether to have back amortization or not. We broadly agree with the conclusion of the IASB that it is not possible to achieve a new model with major differences from what we currently have. But nevertheless, we don't consider that the over-optimism is necessarily best addressed by auditors and regulators. And we also tried to put forward to consultation a number of possible enhancements to the existing model. For example, reviewing the current guidance on allocation of goodwill to CGUs, reducing the shielding effect with a more granular allocation, for example, with a rebuttable presumption that the CGU is lower than a segment. This is one of our proposals. We also suggest to limit the possibility to reallocate goodwill in case of a reorganization unless there is evidence that there is a change in the cash flow structure. And therefore also align the impairment test with the expected benefits at the acquisition. We don't support the proposal that was illustrated by Nick to present total equity excluding goodwill, because this would be confusing for the nature of goodwill. Is it really an asset or not, and why it's sitting on in the assets to begin with? So we consider that the users will in any case have this information available for their analysis if they want to deduct it from equity. One point that we are consulting is also whether the IASB should consider introducing the reversal of impairment, because we understand that this may play a role in the behavioral tendency not to impair timely. And we are very keen in having input on this point. Finally, for the over-optimism, we are also exposing for comments possible directions of disclosure to help address this issue. Like, for example, compare the realized cash flows with the predictions, disclose the assumptions used for the period for which cash flows are projected based on financial budgets, so the intermediary period, the explicit period of the valuation, and also what are the current level of cash flows, margins and earnings. So providing more information to make the management more accountable on the input that they are using. Next slide, please. On the big question whether goodwill should be amortized, yes or not, we haven't exposed a view. Views in Europe have been split since many years, and they were again split when we first discussed this paper. So I totally agree with Nick when he says that there are conceptual arguments in both camps, and our draft comment letter illustrates an entire catalogue of these arguments. So we are also, similarly to the IASB, looking for new evidences or new ways to look at the existing previous evidences before taking the direction of a major change. We have also a number of more conceptual questions. One topic that was discussed at our working groups was whether, considering the accounting construct of goodwill being made of several things, whether it is possible to identify components of goodwill that clearly have economically limited useful life and therefore may need to be considered for amortization. So we would welcome input on this possible approach on the components. We also observe that if goodwill were to be amortized, there should be a link between the information provided on when the entity is expected to benefit. Think about the new disclosure that the IASB has designed in this discussion paper, and the amortization period, because one of the open question marks for the amortization is which period the amortization should last. Next slide. On the simplification of the impairment test, our working groups and our board were against the idea to switch completely to an indicator-only approach, except in those conditions where it is already obvious that also performing the test would not bring any additional evidence of impairment. So the reason for this reservation about abandoning the annual requirement that we have today is that, as Nick has anticipated, users believe that the information provided by this test, also if it's not indicative of the recoverable value of the entire entity, but only of the CGU, nevertheless offers important insights into the future value of the company. But also because we consider that the behavioral issues that we have with the too little too late may be even worsened by switching to an impairment or to an indicator-only approach. So we see benefits in the robustness of the system to keep that the annual calculation in place. We support the refinements to the value used. They were very much aligned with our views in previous discussion papers on this. However, we would welcome additional guidance on the inclusion of the restructuring cash flows. In particular, there were doubts about a gain over optimism being introduced with this move. On intangible assets, we agree we believe that it's not a good move to have more intangible assets subsumed into goodwill, because analysts have already their issues in understanding recoverability of goodwill, and we don't want to make this even more obscure, adding intangibles as part of it. But we also suggest the IASB to look at the issue about comparability between internally generated and then externally acquired intangibles, not in this project because it's already ambitious, but very soon in their agenda. On the convergence, we consider that it's an aspirational, very important goal, but nevertheless, we formed our view and response independently from what the FASB is going to do, at least at this stage. Then we will see what happens when we discuss the final comment letter. Finally, we also suggest more guidance on goodwill allocation when an entity divests the part of the business, because we see that this is another point where some behavior may be observed, and more guidance on derecognition of the goodwill attached to what is sold may help. I think this was the last slide, Sedat, if I'm not wrong. So with this, I think perhaps only I remind that there is still time if preparers are interested to contribute to our survey. There is a questionnaire available on our website, still a few days to contribute on that. And our comment deadline is 30 November. Thank you very much.
Thank you, Chiara. I think that was very clear. So after that Nick presented the IASB position, the main elements that are relevant to our discussion, and Chiara gave the EFRAG views on it, it's now time that we move to the views of the investors. And I'm going to hand over to Hans Buysse, who is going to moderate this discussion, including polling questions. And we just want to remind you that you can also type in questions you have, or statements you want to make into the tool so that we will address them as well. Hans, over to you.
Indeed, Saskia. So if people would like to ask a question at any possible time, please put them into the system and we will, of course, direct them to the appropriate person. But first of all, I would like to introduce to you our panel of this evening. And I will first start with the ladies. First member of the panel is Sue Harding, who is an independent company reporting and governance analyst with over more than 30 years of experience, ranging for performing equity and credit analysis, developing and interpreting IFRS and US GAAP requirements. Sue was global head of accounting and governance equity research at Citibank, and prior to that, she directed the Financial Reporting Council's Report Lab. She's a very, very well-respected member of EFRAG's user panel, and by the way, if we have other people who would be interested to be part of that user panel, you're certainly welcome. The second lady that I would like to introduce to you is Marisa Amazo. She has more than 30 years of experience into the financial sector. She joined GVC Gaisco as Deputy Director of the Analysis Department from Bankinter Securities in 2019. And she's a member of the Commission Financial Reporting of the Instituto Español de Analistas Financieros, which is, of course, very close to our financial analysts. The gentlemen that I would like to introduce are, first of all, Wouter Verlinden. He manages the VSQ Small Cap Private Equity Factor Fund. He has a background in private equity as a partner with D2E Capital, Down to Earth Capital, and associate at GIMF. He started his career at PwC. And last but not least, we have Steve Cooper. Steve Cooper completed a 10-year term as a board member of the IASB. Prior to that, he was the managing director in the equities division of UBS, and he's now an independent analyst and writes the Footnotes Analyst blog. I do welcome all different members, and I propose that we go for the first question. First question, of course, is about acquisition performance. How do investors analyze acquisitions, and how do you use disclosures into this regard? So this is about what is the information that we can find that is useful, what information are we missing? I would like to start with Steve. Steve, your views.
Okay, thanks, Hans, and thank you for inviting me to participate today. So in terms of how do investors analyze acquisitions, I think the discussion paper has got it right in emphasizing two aspects of this, which is how an acquisition impacts the entity, how it impacts the balance sheet, cash flows, and then secondly, is the acquisition decision a good one or a bad one? So in terms of the first, what's the impact of an acquisition? Obviously, investors have to think about updating models, updating forecasts, thinking about where profitability and cash flow is going to go as a result of the acquisition, how it's going to change. So they need information to be able to do that. Of course, it's important to remember it's not just financial statements that provide that information. So at the time of an acquisition, there'll be investor presentations. You may even get a prospectus, an offer document, but not always. But I still think that it is important that that objective of providing information about the impact of an acquisition is provided in financial statements as well. The purchase price allocation information and then the pro forma results disclosures, which have been described, I think contribute to that. I think both could be better, and I certainly welcome the changes the IASB is proposing in both of those areas. I would have liked to have gone a bit further in the purchase price allocation. I'd like to see the sort of the fair value uplifts and a bit more information about the changes that are actually taking place from the previous financial statements to what's then consolidated. I think the disclosures about synergies are welcome as well. I think that's an area where, whilst you might get that in investor presentations, it's not necessarily something that you'll typically see in financial statements. So that whole area, I think, has been well identified by the IASB, and the proposals are certainly moving things in the right direction and will be of great help. The second decision, or the use of the information, which is, was the acquisition a good or a bad decision by management? I think that's an area where there's more of a challenge. So in my view, there is often little or no opportunity to assess that. Typically, the disclosures tend to stop, and the management is focusing much more on the business now and the business going forward, rather than sort of auditing past decisions. And then maybe for serial acquirers, you can form a view about the benefit or not of what they're doing. If an acquisition becomes a separate segment, certainly you can then see much more clearly what's going on. But otherwise, I think it's quite difficult to assess that question of is it a good or a bad acquisition. Now, I recognize the difficulty in this area. I mean, I was in a company the other day, and the business was integrated with the existing operations almost immediately, and its separate identity was immediately lost. So I recognize the challenges, but and I think the sort of the CODN type approach perhaps is the most practical way of doing it. I do agree, though, with the EFRAG comment that a lower level would be better than at the CODN level. I think that's quite important.
Yeah, to imply management more.
Yeah, exactly. Yeah. I also think that this is much more suited to management commentary than financial statements, but then I recognize the IASB has no ability to mandate something in management commentary, so I can understand why they go on the route of financial statements.
Okay, thank you very much, Steve. Sue, what is your point of view on this performance? You're still on mute, Sue. You need to unmute.
I've done it. No one else has to. No one else has to now. Obviously, we're talking about significant adjustments, and I think that's key in terms of the discussion. And this can kind of seem like an area that, on the one hand, investors want acquisition accounting that fully reflects the value paid, the value that's invested in the acquired entity. On the other hand, they seem very frustrated by acquisition accounting and want almost none of it and systematically then rip it apart. And I think maybe it would be helpful to sort of disaggregate that a little bit. Clearly, if it's a large, significant investment, there's comprehensive changes across all of the financial statements. So your balance sheet, your income statement, and of course cash flows. And analysts are always sort of topping up their information. So yes, there's an acquisition, but there's probably a lot of other things going on as well. But what they need to work out about the acquisition is sort of how incrementally it's going to affect the company. And one thing that they quite generally just have difficulty working out in the context of financial analysis is, why certain balances are changing over time, what's in the income statement, what's in the cash flows that affect balance sheet amounts, and just sort of being able to kind of think things through and how they're changing, and essentially get comfort that nothing was missed in a way. And acquisitions, it's a big step change in essentially bringing in the entity. Normal accounting is disrupted by this purchase price accounting, which I feel is an important step to fully reflect the value. But you also have this issue of periods with and without the acquired entity, or sort of part year inclusion, that affect all of the year-over-year analysis. So it's an area that investors are rather frustrated with, as well as being very interested in. I think the needs and the uses sort of break down to two general areas: the sort of assessing operating performance and, of course, associated cash flows. That sort of focuses on understanding, sort of stepping back from the acquisition, is just understanding of the past to forecast the future. And in this context, with the level of disruption by new entity being included, and values of being, written up or down that aren't normally written up, this sort of disconnect in the accounting, it can be very difficult to sort of unpick the effects, think about what is in reported information. I'm thinking sort of post-acquisition, that post-acquisition reported information. What are the effects when you think about performance of the fair value adjustments and the new assets appearing? So we may not have information on former values and the fair value adjustments that were made, but clearly those fair value adjustments in going from the old entity to the acquired entity, but clearly those uplifts sort of disrupt the accounting and mean we're receiving different information in the operating performance. Inventory adjustments reduce reported margins, since they're uplifted at acquisition. That's going to revert. That creates a negative trend. Amortization of new intangibles that suddenly appear, well, they'll end eventually, and that creates a positive trend over period analysis. And these things are sort of false in a way, because they're all related to the acquisition. So that's, I think, why you see analysts sort of wanting full information and sort of adjusting lots of the operating information. In addition to the operating analysis, there's the stewardship analysis, and there investors do want sort of full purchase price accounting. That accountability for the value invested is quite important. Separate disclosure of amounts that have been either amortized or impaired, as sort of cumulative amounts to sort of add back to make sure that we're actually still holding management accountable for the full investment, is all very important. And I think if you think about the information with the comprehensive changes that are occurring to the financials as the new acquired entity is consolidated, there can be a gap in the disclosure, where you get some of the balance sheet but not all, or some of the income statement disclosures but not all. And that is one of the frustrations. So I think disaggregation of reported amounts and steps to provide disaggregated information of what's there is important. And yes, some of the pro forma information that's being suggested can also be quite important to look at the sort of trend analysis and understand things going forward.
Okay, thank you very much. Before we go to the second question, and in order to have our audience as active as possible, I would like to ask two poll questions that Gloria will show to the audience immediately. And the first one is, of course, in your experience, are management able to answer investor questions about the subsequent performance of an acquisition, i.e., are they aware of how well an acquisition is performing? And of course, you will get 4 possible answers to that one. The second polling question that we have here is the following. If the information about the IASB requires to be disclosed is commercially sensitive or sensitive because of internal reasons, for instance, potential restructurings, is that a good enough reasons for companies not to provide this information to the investors? So here again, from the audience, I would like to have an answer, whether that is a yes or a no, or a we have other remarks. Please do fill in those questions one by one. And in the meantime, I understand that we will go further with the second question to our panel. In our experience, do management monitor whether acquisitions are successful? And do they have the information that you really need? And I would like to ask, first of all, Wouter's opinion on that one. Wouter.
Yes. In my opinion, if you ask management the question, do you monitor acquisitions? You usually get yes for an answer. But if you ask management the question, do you treat your people correctly? You will also get the yes answer, and there are a lot of disgruntled employees. I would more make the statement that successful acquisitions have good monitoring rather than the other way around. Now, what is monitoring and what should management be looking for? That's, of course, different for every other acquisition that is made. I work a lot with, for instance, conglomerates or people that do temporary acquisitions and then resell the business after several years. And that kind of monitoring is different from a buy and build strategy in an industrial company or a tech investor that does an acquisition for intellectual property reasons. So I think that the management does not always monitor the business in the same way, and it should not be done that way. So every acquisition requires a tailor-made solution, and having the information necessary to monitor those acquisitions on a tailor-made solutions is in fact a very important metric to determine the quality of the management. A good management will have a select number of KPIs or monitoring factors that match the criteria of their acquisition. A bad management or a less well-performing management will probably only monitoring very high level factors. So in general, so I think that most management teams have some kind of monitoring in place, especially for material acquisitions. I'm not saying that for every very small acquisitions, for every small acquisition there is a monitoring, but normally for material acquisition, management is monitoring the situation. The question is whether they're monitoring that in the most efficient way or the most that they're monitoring the factors with the most impact on the acquisition. And a sharing of the management with that, if the management would share part of the information that they are monitoring, would not only give a very good impression on how the acquisition is doing, but also on the quality of management. How well are they able to define certain KPIs or certain fields that they want to take into account. So if a management would have very bad factors, that would be a factor for me not to invest in a company. So I'm very much in favor of sharing the information, whatever the management has, and making my conclusions about that.
Okay. And Marisa, what are your views on this? Do management monitor whether acquisitions are successful, and do they have the information that you need? I am looking for Marisa, but it's
here. Thank you very much, Hans, for inviting us to this meeting. My personal view on this is that we have three major differences or different situations. We may differentiate between large cap and small caps. We should differentiate between regulated companies and non-regulated companies. And in the third place, we should differentiate between very important acquisitions or transformation acquisitions from small acquisitions. In those sense, my personal experience is that when you're talking to large companies that are regulated, they usually do monitor the acquisitions. They do have the information, and other thing is whether they release it to you or not. They usually do not include much of this information in the financial statements, but they do include it in strategic presentations or quarterly presentations, so we can monitor how the achievements are progressing. They usually last this monitor for 1 or 2 years, depending on their aim, and it's usually with very important acquisitions. If we go to small caps, they probably have less information than large caps, but they are very reluctant to tell us about their secrets. So we have less information regarding how the company is evolving, about how the acquisition is evolving. So in that sense, it could be improved. Other thing is that we should balance the cost of releasing all this information with the real benefits for the company of giving us those information, and that's a very difficult balance to do. Finally, with regulated companies, we have, I would say, excessive information. We were talking the other day regarding the financial institutions that they release roughly 1,000 pages per quarter. And the key there is not is that there is no information, is looking inside these 1,000 pages per quarter to really extract what is valuable information. So in that sense, my personal view is that it should be better to reduce the information and just focus on what's really worthwhile for investors and for analysts. So to end with my opinion is it depends on the companies. My personal experience is that large companies, they do. Other things that they release it or not. And small caps, they do never release this information. Thank you.
Okay, thank you very much. In the meantime, we have the answers already on the 2 questions that we were asking or posing or polling. And the first one was, in your experience, are management able to answer investor questions about the subsequent performance of an acquisition? Are they aware of how well an acquisition is performing? We see there that we have 48% answering yes, management are usually able to answer questions in investor calls, but we also see that in not all the cases they are able to that. It is rather a very low number, where we see only 8.7%, where we see no for other reasons. And on the second question, if the information that the IASB requires to be disclosed is commercially sensitive or sensitive because of internal reasons, for instance, a potential restructuring, is that a good enough reason for companies not to provide the information to investors? What we see here is in our scores that we have 45, almost 46% of people thinking, yes, companies should not be made obliged to disclose information that could do competitive or internal harm. And we see 33% that says no. If some of the information is commercially sensitive, then it should be disclosed. And we have 21% of people that say, no, I do not think the information will be commercially sensitive in any way. Any reactions from our panel to those first two poll questions? I don't see a specific reaction. So I will continue with our third question. But in the meantime, we have two other poll questions that I would like to ask to the public at large. And the first one is, of course, if, just one second, if the IASB were to require information about subsequent performance of acquisitions, should it be based on what management, what we say the chief operating decision maker, reviews? Steve has already mentioned something about that, ladies and gentlemen, and Gloria will show you the question on the poll immediately. And the next question before we move on is, again, for the public at large, do you agree with the IASB's proposal to present the proposed information in the notes to the financial statements and be audited, of course? Or would you prefer it in the management commentary, which cannot be mandated by the IASB and, of course, would not be audited? Those two poll questions are there for your answering. Please do so, and we will come back to that in a sec. In the meantime, I will continue with our panel with the next question that I would like to address to Wouter. How should the IASB balance concerns about commercial sensitive and the needs of investor professionals? Wouter, your views.
Yes, I think this is the most tricky question from an investor point of view. So I think the main concern here is, of course, if it concerns trade secrets and stuff like that, it should not be disclosed, but it is not disclosed anyway now. I think the largest part is about the price. So if you do an acquisition, what do you do with the price and the valuation metric that you use? Do you fully disclose that? Of course, you can find in the cash flow the cash that the company spends to purchase it, but you don't have any information on the financing structure, on the debt that is used, the leverage multiples, perhaps covenants that are used in the acquisition. And in general, management is fairly reluctant to share information on what basis the valuation was made. Was it made on an EBITDA multiple and a discounted cash flow? Which growth rates were used in the discounted cash flow and stuff like that. I don't know why management is reluctant to share that information. I think sometimes they might be worried that the market will react badly if the acquisition price that is paid is not or is too high. But then again, I think that is the function of the markets. It is both a two-way communication about decisions of the management, and I think that my personal opinion is that the management should disclose the prices and let the market react to what the management has done. On the other hand, I also understand that if you're in a buy and build situation, disclosing the price that you paid 2 months ago, if you're working on another acquisition, might have a negative impact on the current price settings for the acquisitions that you're doing. But in general, I think that the benefit of the market knowing the price and the valuation metric is larger than the damage it might do to the company. And in my opinion, getting public money is a cheaper way to get financing. The downside of that is that you'd have to disclose a little bit more information than a standard company. And I think that pricing and valuation metrics and growth rates that were used in determining the value should be shared with the investor audience.
Thank you, Wouter, because that was one of the comments that we received. I saw a comment coming up saying some companies are reluctant to disclose certain assumptions, such growth rate on growth rate related to cash flows, as they do not want to disclose this to their competitors, of course.
Yes.
Okay, thank you. Sue, your points of view on this commercial sensitivity and the needs of investor professionals. Oh, the button.
Almost did it again. Yeah, so I think this one too, I would come at from the vantage point of context. I think obviously nobody wishes any harm done internally or competitively externally. But I do think it's increasingly normal to disclose strategy, company's business model. We've got requirements now across Europe on that. Disclose KPIs and targets, objectives, dividend policies, capital management and the like. And then, provide an update on how things went or how decisions were taken. So if I kind of then look at acquisitions, you've got the disclosures that may occur pre-acquisition, at the acquisition, or about the acquisition date, and then post the acquisition. And I think it's, I don't think what's being asked for is likely to actually be so sensitive and surprising that it could not be disclosed. And maybe we take those other broader disclosures as the lead on this, because we have an existing strategy of a company or an understanding of that strategy and its business model. Did that build in an expectation that there would be acquisitions or not? Maybe if it's an acquisition out of the blue, that's going to surprise people anyway. But in any event, they'll want to know the specific objectives. Overall price, I think, is quite important for accountability. That goes back to the stewardship angle and accountability for the price paid. And of course, sometimes the shareholders get a vote on the acquisition. So what information, do they gather at that stage, gain at that stage from the company on those sort of expectation setting disclosures? Price should include the debt assumed. You've got then the acquisition accounting. We've talked a little bit about how that accounting is so comprehensively changing of the financial statements, and just sort of a comprehensive update on those figures is helpful. But then post-acquisition, I think there too, whether objectives have been met, it's going to be in the context of, if not specifically to the acquisition, in the context of those broader strategic goals and targets that the company has set and the disclosure of those. So I think, most companies, all companies really, can find a way through this to provide some information that, we're all grown-ups, investors are grown-ups, employees are grown-ups too, information that is meaningful, that is integrated into the overall picture of the company and the understanding of that. I think I would also just mention, I've often been told, if you want to know about a company, just ask its competitors. So quite often information that is, so sensitive to competitive positions isn't really all that unknown. The competitors have a pretty close view in any event. So I would challenge the assertions of commercial and internal sensitivity. I think sort of backing up from it, we can get to that sort of broader context.
Yeah, but then apart from asking its competitors, I have one extra question. Can we have a comment on the importance of auditing of this information? Should we also ask the auditors? In some cases, this may require further guidance to allow auditors to sign off. Anybody of the panel that wants to add something to that? Wouter, Sue, Steve, or Marisa?
In my opinion, since some of the decisions are made on normalized data or management information coming from the acquiring company, I think it's very hard to ask a company to to audit those numbers. I think, in my opinion, those are in the realm of management information and not in the realm of audited financials. But that's my opinion. So I should, especially since I work with small caps, I think most finance departments have work enough already, and having an extra audit on numbers they didn't create sometimes is creating more work for very little additional benefit.
Okay, any further reactions to that?
I think I would just differentiate from disclosure of price and disclosure of that more detailed, perhaps with inside information as to how normalized figures and the basis for that price was determined. You know, as an external party, I think normally the pricing, whether it was fair, would at least initially be looked at, again, sort of external factors and what were, you know, what's common to the industry, say, in terms of how entities are priced. So again, I think we can get around it without providing detail that isn't that is sort of internal and subject to non-disclosures and all that.
Yeah, okay. Thank you very much. In the meantime, we have the results of the second poll. And we also have a number of questions from the audience, so I will have to speed up a little bit. On the third question in the poll, if the IASB were to require information about subsequent performance of acquisition, should it be based on what management reviews? There we have a little bit of a mixed answer. 32% thinks, yes, it's a pragmatic approach, balancing the benefits of the disclosure with the costs of providing the information. 28% says, no, the IASB should not introduce another threshold into IFRS. Companies should apply materiality judgments to determine what to disclose. Not sure whether the IASB wants to react to that. I will first read the second one. Do you agree with the IASB's proposal to present the proposed information in the notes to the financial statements, or would you prefer it in the management commentary? Here we see 35% that says no, it would be difficult and costly to audit this information, as we heard already from Wouter, and should be disclosed in the management commentary. Management commentary does not fall under IFRS and is not subject to an audit. Are the responses that we received to that? Nick, would you like to react to that, or give me your thoughts?
Yeah, sure. I mean, there's a lot there. I mean, in terms of the location, clearly what we hear very much from investors, I think one of the key takeaways the board had is that investors are much more interested in the economics of mergers and acquisitions, and less interested perhaps in the accounting for goodwill. And as often as accountants, we focus much more on the accounting for goodwill rather than the economics of these transactions. And really, this is what the work around subsequent performance, around better pro forma information is directed at. And so we've heard this very strong call, I would say, we've heard from investors certainly for better information in this space. I think, as already been highlighted, we can't mandate what goes into management commentary. The only place that we can ensure this information is available to investors is through the financial statements. So we could say, yes, it'd be very nice to have in management commentary. We already have evidence that management have this information to hand, but it's not very often provided in management commentary. Clearly, you know, a lot of capital is being deployed in these transactions, and I think it's right that investors can hold management to account for them.
Yep. Thank you very much, Nick. We also have a question coming directly from the public, and I think it's also versus the IASB. The question is, regarding information about subsequent performance, does not this force the management to present earnings estimates and other estimated KPIs for the acquired company, or openly refer to how an acquisition performs compared to the estimates? Is it not easier and more useful to require the management to present simply estimates for the total group?
So I would have sit there as an investor, and as I say, I think capital allocation is one of the most important things that management do. And I want to make a judgment before investing in a company. That's why it's important to have this in the report and accounts, so I can go back to historic report and accounts and look at deals. Is this a good company at allocating capital into M&A? Yes or no. And actually, I think many of the proposals we have are about building up a better answer to that. And just disclosing forward estimates for the whole group won't particularly help me with that one way or another. So it's about isolating the information, whether it be about better pro forma information, about ensuring you know how much debt has been assumed with the acquisition, whether it's about the subsequent performance. It helps me build up a picture as an investor, whether I want to give more capital to this management to deploy or not.
Okay, thank you very much, Nick. We have another question coming from the audience to everybody in the panel, including also the IASB. And the question is, based on your experience, what are the top 3 areas of information needed to be disclosed related to goodwill? But we're already moving ahead, I think. Any reactions to that?
Hans, I haven't got a reaction to that, but I did have a reaction to the previous question.
Okay.
Which I thought was quite interesting, because the discussion paper is focusing on acquisitions, but of course there are many other important strategic decisions that companies take. And arguably, some of the disclosures that we're talking about here perhaps should apply more widely, which is maybe twisting the question a little bit, but that's perhaps what we're getting at is this sort of wider application. And major restructuring decisions, new supply chain, even the decision not to sell a business rather than a decision to buy a business also is an important decision that management is taking. And you could argue that similar disclosure should apply there. Now, I'm not suggesting that the board should scope creep and start thinking about much wider disclosures, but I thought it was an interesting question nevertheless, and brought those thoughts to my mind.
Okay, thank you very much, Steve. I think in care of time, I will need to continue to the next question, bring us also to the next section, now on impairment simplification and potential improvements. And the question is there really a problem with the current impairment requirements? Why or why not? Or there is a problem and it can be improved, or we believe that there is not a problem. Marisa, can I ask you for your views on this one?
Well, again, as in my previous question, I still differentiate between large caps and small caps. For large caps that have enough resources, there is not a problem. It's time consuming, it's resources consuming, that is not a problem. For small caps, it may cause them a problem because the cost of doing all the impairment tests may be higher than the benefits that they get from that tests. I would say that from my personal experience, impairment tests have always come with some delay with market price evolution of the company. So I would say that prices in the market is always come ahead of the management decision of making an impairment. Could be because of the delay on presenting the financial accounts, could be because their willingness of small problems to disappear in the medium term, or you know that markets always anticipate what's going on. I would say also that what my personal experience is that they usually use bad years to make all impairments, whether they are relevant or not. So, for instance, this year, due to the COVID pandemic, we've seen tons and tons of impairments. Some of them came from 2 or 3 years ago, and I can give you some examples. But now, with everybody reporting poor results, we will all forget about these impairments. So they will show from year 2021 onwards a clean balance sheet. So there are many problems with the timing, the depth, and how they do that. And I would say that markets always discount these news on advance to the goodwill impairment that management makes.
So it's the moment to do all the impairments at once, since we are being heavily under attack due to COVID, and as such you will see a lot more impairments that we normally do over the last 6 months. Steve, anything to add on this one?
Yeah, I agree with Joe's comments on that. I think that's very valid. I mean, there's always going to be a lag, isn't there, with impairment tests, because financial statements, report what's happened in the past. So you can't get away from that. But there are two things, I think. Firstly, the willingness of management to be realistic, and the willingness of auditors and regulators to push them to be realistic. And then secondly, the test itself. And I think the fundamental problem with the Goodwill Impairment test is that it doesn't actually test goodwill. I know Nick said that it's an indirect test of goodwill, I think in his presentation, but I'm not sure that I would even go as far as to say it's an indirect test. I just don't think it is a test at all, because all it's doing is testing the carrying value of a cash generating unit and then allocating any difference between book value and carrying and recoverable amount to the goodwill. I think if the shielding were dealt with, then I think it would become an indirect test of goodwill. But if the shielding isn't dealt with, and I understand the IASB reached the conclusion it's not possible, I would have liked to have seen at least an attempt to have implemented that. But without shielding, I think it's actually not testing goodwill at all. In fact, I would even suggest that it might be renamed. It's the carrying value of a cash generating unit impairment test, and not even pretend that it's really testing the goodwill itself. It's just trying to make sure that the balance sheet total isn't too big relative to the recoverable amount of that cash generating unit. So I think maybe I'd just move away from thinking that it's an impairment test of goodwill. In fact, I might even rename goodwill, because people get the impression that there's something there when you give it a name like that. I might even rename it acquisition premium. I think it's a better descriptor of what it actually is.
Yeah, it's a point often heard by users as well. You mentioned two different points. You mentioned on the one hand side, okay, the calculation of this, let's say, impairment, but on the other hand side also the situation we're in. So what you hear often is management over-optimism seems to be often, or is oftenly raised as a problem relating to problems around impairment. How do you cope with it or adjust to it in general and around impairment specifically? Sue, any views on that from your side?
Yeah, well, it is an aspect of the problem. As Steve has referred to and Nick has referred to, this sort of bundling up with other things. It isn't a direct assessment, so that's as big a part of the problem. In terms of working with investors and analysts, the relevance of an impairment charge is currently a really hard sell. And I can say things in working with them, the sector analysts, a charge does, of course, reflect diminished expectations of cash flow, because the usual starting point is it's not cash flow, I don't care. But it's a signal on cash flow. The problem is, yes, it is. It could be important. I do advocate them looking at it. But it's very infrequent, if ever. I can't really think of a situation where someone has said, this is news to me, I haven't already factored in this or worse. So it's just there. I'm not sure there's a direct dealing with it in a way. Some say that they like to see the assumptions and sensitivity analysis that is being provided, that it can be useful. Of course, there are other areas to kind of look for expectations of the future, and some of that is, of course, outside of the financial statements. But I think it's interesting to think about what's in and what's out, a lot of this information that's outside of the financials, sort of in the strategy and the targeting, embedded growth assumptions to reach those targets, if you will. It's already there, and certainly at a overall entity level, it can be obtained. So some of what's done with the current information is just a check between, front and back half of the financials in terms of seeing if there's anything to be learned mainly from discrepancies. But at the end of the day, investors, analysts, they'll have their own views, and they don't necessarily tackle the assumptions. It would be interesting to work out why auditors and regulators may or may not be able to tackle optimism in this sense. But I'm not sure it's getting us as far as we need to go. It's a lot of work, apparently, I would think, and it's not providing useful information and useful insight.
So, Sue, if I understand you correctly, over-optimism is not the main problem. I'll link it to what Steve already said. Shielding is a problem. And for that, goodwill should be allocated as low as possible. We feel a certain lack of guidance is something I understand. And you tackled also the role of auditors, regulators, more skepticism, more challenge. Marisa, your points of view on this one?
Well, I agree with Sue's assert that, that both auditors and regulators should have a word in here. A management, whenever they do management presentations, either to analysts or investors, we have to consider that they are salespeople. You're selling their product, and their product is its company. So whenever you talk to a salesman, you always know that they are overselling their product. So over-optimism is usually goes with the salesperson. And that's the way the management presents their accounts, their strategy, and their future. In good times, they usually they're over-optimistic on how long will last the growing period. In bad times, they're always over-optimistic in how they will cope with economic crisis. But this is one thing that the analysts would have to balance and to know how much of this over-optimism is included or not in their figures. Outside of the financial accounts, they usually give to us some background on their GDP estimates, their market estimates, or other more precise figures. And there you have some judge to realize whether they're optimistic or not. In financial statements regarding goodwill impairments, I would say that this over-optimism may cause some delay in doing the impairments. In that case, I guess that auditors and probably regulators for regulated companies should take a hand or provoke them to do the impairment in advance and with perhaps tougher assumptions than the ones the company or the management is using. Thank you.
Okay. So let's check with the audience again through a poll if there's any reactions there. And Gloria, I would like you to pop up two more poll questions. And the first one is, do you think that goodwill impairment testing could be improved such that investors rely more on it? We've heard what the panel said, but what are your views? And the second question would be to pop up is, should the IASB adopt an indicator-only approach, removing the requirement to perform an annual quantitative test? So those questions will be shown to the public. And in the meantime, we can continue again with the panel to the next question. And the next question is specifically on this indicator-only approach. So do you think the indicator-only approach for impairment would improve the current position? Yes, no, maybe, it depends. Are the things I would like to discuss. Sue, may I revert to you again?
Sure. Yeah, I mean, it's slightly bizarre, isn't it? You sort of say that the current approach isn't working. And I know there's been at least, well, probably a good amount of analysis into whether we can improve it, and apparently the conclusion so far is no. I do still think that maybe some more work along those lines should be put into it. But it is bizarre and could almost be looked at, okay, let's not bother now, in terms of the indicator only. But I think it could, if we really can't improve it, it's not being used, it's not providing useful information that sort of can't be generally gleaned elsewhere. One of my colleagues at Bailey Network advocates this no impairment, keep the goodwill until it is, the entity is sold or the doors are closed, that Nick mentioned. I was surprised that came up in the discussion. I think that would be quite a strange one as well. It would mean no check on overvalued assets, and I think it's not a good look for standard setters, regulators, or indeed companies not to have some check on overstated assets. And that check or the resulting accounting information can only be as good as the requirements to check. Maybe an indicator-based system would provide at least some analysis of that triggering event and the same sort of assessment. It still would be kind of embedded residual assessment. It would still be subject, I would think, to the vagaries of over-optimistic assumptions. I would be quite, but I wouldn't rule it out. In that what we've got isn't really providing the insight we need. And I haven't studied this, but it would be quite interesting to know whether annual testing in and of its, on its own has led to significant impairment charges. I don't know the answer to that, but if it has, why and what circumstances has it led to impairment? And if not, why not? But before eliminating it, understand the sort of the utility of that part of the tool to ward against overvalued assets.
Okay, thanks, Sue. Steve, your points on this, your point of view on this indicator-only approach for impairment.
I think I'm going to largely agree with Sue. My answer is maybe. Considering that the usefulness of what comes out of the impairment test is questionable, maybe the cost savings, could be justified. But then I quickly revert to what I think is my actual answer, which is no, it's a bad idea. I mean, let's try and keep this test as good as possible and maintain the information. And I think it would weaken the test. My ideal would be to improve the test. But even if it isn't improved, I still, on balance, think it's a bad idea to move to an indicator-only approach. It was interesting that Sue said, why don't we perhaps think about no impairment ever and just keep it on the face of the balance sheet? I actually have always quite liked the old UK approach and used elsewhere as well of immediate write-off and just get rid of it from the balance sheet, but not forget about it entirely, but keep it forever somewhere else. Which is kind of perhaps similar to Sue's colleague in some respects, because if impairment isn't really providing the signal about bad acquisition, which I don't think it does, then is it really worth the while? But one other thing, the changes which are being made to the value in use calculation, which I agree with, actually make it very close to fair value. And one other way of simplifying the whole thing would be to ditch the higher of and just go for one or other of those. I would go for fair value. I know others have said value in use, but that would be a way in which I might perhaps reduce costs instead of going to the indicator-only approach.
Okay, thanks. Wouter, your point of view on the indicator-only approach?
Yeah, I agree with Steve here as well. We're all looking at the question that we're trying to answer is management a good capital allocator in its acquisitions? And then providing a test that would be more subjective and more in hands of the management to play around with. Let's put it like that. Would be beneficial for bad capital allocators. And I think a test with as much quantitative, let's say, rigor in it is the best solution in this case, I think.
Okay. In the meantime, I received 2 questions from the audience, specifically on improvements on this impairment. The first one is, often when companies change CEO, a goodwill impairment will follow. Does that not show that the impairment test is too subjective? Anybody wants to take that one?
Yes, that's the point that the same for COVID. When you're cleaning out the closet, it's best to throw everything away. You see the same problem with a new CFO or a new CEO arriving in the company and getting rid of all the problems of the past. So I agree with the liberty that management can take with the impairment test in that case. So that yes, I think that the question is right in the sense that it is a little bit too loose and that it is a little bit too easy to orchestrate the impairment tests so that all the bad news is coming together. And I agree that there's a lot of playing around with the moment where an impairment is recognized. Yes.
I see a hands raised by Chiara.
Yes, I wanted to say that perhaps sometimes with the arrival of a new CEO, there is also a review of the strategy and an approval of new business plans, which genuinely may trigger an impairment. I want to be less critical there.
Okay, thank you. I still have a second question, and then we still need to go to the polls. The second question is, would it make more sense for users if the level tested was a segment with goodwill clearly allocated so that users can check their own views about the performance? CGUs never have enough visibility except for the notes around the impairment test. Too little, too late, and material inaccuracies would still be visible at the segment level in most cases. Ladies, gentlemen, any reactions? I see Marisa wants to react.
Yeah, well, I would say that it depends. Sometimes it's very difficult to do a segment approach, for instance, in mergers. When you combine the assets of the old entity with the acquired entity. So in that case, what is the segment? So it's very difficult. Sometimes when you acquire a business that is, for instance, outside your country of origins, and you maintain the new company acquired as a separate operation, it's simpler. So, myself as an analyst, I would have all the information to make a great judgment of what's going on and how profitable are the acquisition of the company. But I'm realistic from a point of view that not always they would like to give us all the information, or even is not possible.
Okay, thank you. I saw that Nick wanted to react as well. Nick?
Yeah, I guess I can understand intuitively why it would make sense to do it on a sector basis, given that that's the way many analysts certainly build up their forecasts and think about a business. But in practice, it would mean you'd have probably on average CGUs at a higher level. You would result in more shielding by bringing it at a sector level. So it would work against. You'd have even less impairments, I think. So because intuitively I can understand it, but it would compound the problem rather than alleviate the problem, I think.
Okay, thanks, Nick. Okay, shall we have a look at the polls? Just wait 1 second. Oh, we have, the question was, do you think that goodwill impairment testing could be improved such that investors rely more on it? I have a very split results. 31.5%, so 32% says yes, current goodwill allocation and goodwill reallocation requirements might provide room for opportunistic behavior, and some amendments could improve how the test is applied in practice. And to the second question, the rest, honestly speaking, to the first question, the rest is also yes. Yes, specific disclosures to prevent management over optimism should be required. was also a reaction. And the third one, yes, with 16%, better guidance and transparency on identifying triggering events would really be helpful. On the other poll question, should the IASB adopt an indicator-only approach, removing the requirement to perform an annual quantitative test? I do have 37% that says yes. It would reduce complexity and would allow cost savings for preparers by reducing the frequency of the test without making the test significantly less robust. So here I get diverging views of what we just heard. And then, of course, I have 10.5% says no. The problem of management being too optimistic could be increased as auditors, or no, 26%, the complex test would become significantly less robust if companies do not perform an impairment test regularly. The last one was no, this would lead to a loss of information such as estimation inputs. I'm seeing that time moves fast, but does anybody of the panel wants to react to the poll that we got before we move to the 7th question? Quickly. No? Okay, then I will move to the 7th question. Do all investors ignore goodwill and/or goodwill amortization? Is the cost of the investment simply a sunk cost? Answers could be yes or no. Marisa, your views?
My view is that they do not take into account the goodwill. Mainly in financial companies. You know that regarding the BIS agreements, we have to deduct from equity all goodwill. So all financial analysts just forget about goodwill. It's already deducted from our CET1, so we do not take care about goodwill. We will take care about the goodwill that it appears when they acquire institutions, but immediately we write it down from our accounts. And we forget about goodwill amortization. It's a non-issue for the banks.
Yeah, that's specifically for the banking sector, yeah.
For other companies, it's mainly different because they have probably to fulfill some requirements in their issuance of debt. They would have to make some, they would have some covenants regarding debt to equity relationship. So in those cases, you know, we all know it's a non-cash flow item. So we know the price when they pay for it. And from then onwards, either it's goodwill amortization or not, it does not care. I really only care when goodwill amortization is tax deductible. And this is in some countries. So I have to take into account this amortization to forecast the proper amount of taxes, but that's the only example that I think that goodwill amortization is worthwhile.
Thank you, Marisa. Wouter, your points of view?
Yes, I think all investors is a big, it's a big name. I don't think all investors ignore goodwill. There are still pockets of people who look at balance sheets and try to invest in net companies, but accept that those value investors. I think most investors ignore goodwill, and whether goodwill is reflected on the balance sheet of the company or in the level of the share price above that, it doesn't matter. It doesn't matter too much. And in general, I think most investors, including myself, ignore goodwill amortization and ignore the amount of goodwill that is actually on the balance sheet. The main question that you want to answer is the goodwill. Normally the goodwill should be increasing over time, even if it's not reflected on the balance sheet, but that's because of the strategic positioning of the company. And that's more something that you think about than strictly the amount of amortizations of goodwill. That's basically something, if you try to invest in the future cash flows of the company, that's basically something you try to ignore.
No, agreed. Steve? Your point of view?
So on goodwill amortization, the last time we had goodwill amortization, it was ignored, and if it ever comes back again, I think it will still be ignored. The goodwill figure itself, not so sure. So to the extent it represents the investment made in acquisitions, no, it's not ignored. People are very well aware of how much capital has been put into these things. So It's not ignored in that sense, but of course the figure itself isn't perhaps particularly a useful figure considering all the challenges. Well, it's historical, it reflects conditions at the time the acquisition was made, and the impairment perhaps is less than perfect. So not ignored, but not a particularly useful figure.
Okay, thank you very much. Ladies and gentlemen, tricky question. How important is convergence with the FASB on this topic? Steve?
So I'm a big supporter of global harmonization of accounting, but not in this case if the FASB decides to introduce amortization.
Okay, thank you. Wouter, your points of view?
I mainly invest in European small cap companies, so for me it doesn't matter. I have no strong opinion one way or the other, so it's.
Okay, thank you. Okay, we're coming to the end of our panel discussion, and I have a question for all of you, and I would like you to recap in 30 seconds to check what is your message to the IASB and or EFRAG. May I start with the ladies first? Sue.
Okay, I very definitely support further work and work towards an exposure draft on this. I think there's gains for investors and companies. Investors, key disclosures are in fact missing, both in terms of aggregation and some of the sort of pro forma information. And I think within financials, we could use better information to sort of link to that non-financial information outside. For companies, I think there's some gains on some clarity, simplifications, and potentially even an indicator-only basis. So there's things to work through that would benefit both.
Thank you very much, Sue. Marisa.
I agree with Sue that further work should be done in this respect. I would say that whichever decision is made, that it takes very clear how much is the burden for the company to comply with the requirements and which are the benefits for the company itself. So it's not a thing that giving them or making them have a lot of administrative work to make ourselves as analysts life simpler. I would say that as a banking analyst, I would suggest to, as somebody has asked, to directly write down the goodwill. It only distorts the balance sheet. We have to make every quarter the adjustments to our equity because it's not like the CET1. So from a banking perspective, just write down immediately as the accounts or the regulator tells to banks. For other companies, I do have mixed feelings whether to have a treatment directly against equity. So yes, the same treatment that we do with Goodwill, that it arises and goes to the profit and loss account. It would depend on certain companies. It would make more damage than help. But my message is that make things simply, because we want many companies to come into the market, and in the small cap segment, there are some companies that are reluctant to become public because of the burden that we're introducing with all the requirements in accounting. So perhaps, and it's not a thing of this meeting, that we should consider to have different requirements for large companies than for small companies.
Okay, thank you. Steve, your message.
So I very much welcome the proposals. I like the additional disclosures. I hope the IASB takes this forward to an ED. I'd like to see a better purchase price allocation table. I'd like to see more detail, not just the debt and the pensions, but the uplift to fair value. I'd like to see goodwill portrayed as a residual in that table, which it often isn't. I'd like to see the impairment test improved. I really would like the IASB to have another look at the headroom approach. I think that would be beneficial. If that doesn't happen, then let's just drop the term impairment of goodwill, because it isn't really a goodwill impairment, and just talk about it for what it actually is. And please, let's not reintroduce amortization.
Okay, thank you very much. Wouter.
Yes, I have a bit the same conclusion. I think that changes are good, that step by step we stumble forward towards better reporting and better accounting. But especially considering on the European market, the vast majority of the companies are small caps and sometimes really small. Sometimes I speak with finance teams that are 3-4 people, and for the entire company that includes the CFO and controllers. So if putting more work in reporting and reporting standards on sometimes these very small teams is not beneficial for the company as a whole. And I think that a lot of people are asking. We saw a bit the same with IFRS 16, that a lot of people are asking for clarity and for simple rules, especially the smaller companies. And I think as well it might be very beneficial that there are separate sets of rules for smaller and bigger companies that focus more on the strategic importance of an acquisition than the exact accounting treatment of the balance sheet. But that there is sufficient disclosure on the strategic rationale and the fit for the company instead of the accounting numbers.
Okay, thank you. So not too complex, Nick, is the question, and don't start amortizing again. But it's not my task to give the last word. I will give the floor immediately to Serge Partijn. I thank the panel enormously for the good remarks, the good flow of the questions, and over to you, Sergio.
Thank you very much, Hans. Quite a lively discussion with a lot of interesting input. Now, following up on the post-implementation review of IFRS 3, the question might have been, is this a useful project? Was this project necessary? Well, I was not surprised looking into the answers to polling question number 2. 90% of the audience did not get enough information with regard to business combinations, did not get the right information with regard to business combinations, or did get no information at all with regard to business combinations. So that explains why this DP and the project in general on IFRS 3 is very welcomed by the users community. On the disclosure proposals with regard to disclosures, I liked the way Steve phrased the problem. What are we looking for? We are looking for the impact of the business combinations on profits and cash flows. And we also want to understand whether it is a good or a bad acquisition, what I then translate as, is the acquisition creating value? And I think it's interesting for the IASB to build the disclosure requirements around that thinking. What is the impact, and is it a good or a bad acquisition? Is the acquisition creating value? Steve would have done a little bit more, he said, the purchase price allocation. I can follow him on that because I've been looking into a number of annual reports, and it's very often not clear how the purchase price has been allocated, or at least the information with regard to that is often confusing. I would go a step further there, and I would also like to refer to the deal structure in general. Contingent liabilities, contingent considerations, adjustments in the measurement period. All of a sudden, 1 year later, the goodwill is 20 or 25% higher than originally expected. All that kind of information should be disclosed in a more transparent way. With regard to creating value, Sue built on that, referring to the stewardship aspect. I absolutely agree with that. Stewardship is the key issue. Is the management doing the right things with the money, with the capital, the money of the shareholders? That's a crucial question in analysis. So I absolutely agree with her there. With regard to how the acquisitions are monitored or followed up on, Wouter said yes, entities do follow up on their on the business acquisitions that they have done. But I heard some doubts, which means, of course, that if the management doesn't follow up on the business acquisitions, that he has his doubts whether he should invest in the entity. What was interesting was he said, well, the disclosures or how the entity is or is not following up on the queries. It depends, he said, whether you're a private equity player or doing something else or have a buy and build strategy. But that's a difficult one because the IASB has to take into account the nature of the business combination. That's a difficult one to take into consideration. but something we can think of, because Marisa said about the same thing. She said it is the management following up adequately on the business combinations. It depends. You have large caps, small caps, regulated entities, non-regulated entities, big acquisitions, small acquisitions. So it's a challenge for the IASB to strike a balance there. I don't think that's that easy to make the distinction between large caps, small caps, big acquisitions, small caps, but it is what it is. With regard to commercial sensitive information, Wouter, indeed, I agree with that. It's a very tricky question, but I had the impression that the panel wasn't really buying that argument. So Sue said, if you want to understand something about the company, ask its competitors. That information is already there in the market. So don't come up with the argument that something is automatically commercially sensitive. What was interesting was that Wouter, when he was asked to talk about commercially sensitive information, he started a discussion about the price and the structure. And that was interesting because indeed the price and the way the actuary has been valued could be seen as commercially sensitive information, because we're not talking about technology or know-how that has been bought, or a brand name or a market share. It's perhaps also about how the price has been determined and the structure that has been applied setting up the business combination. With regards to impairment, is there a problem with the current impairment test? Well, it wasn't clear to me. Marisa referred to the big bath behavior. If something goes wrong, well, then impair everything. That's the ideal moment to do so. Steve mentioned something about the shielding, and of course the IASB, for the time being, says, okay, the shielding, it's there, let's keep it that way. He would have preferred some kind of solution to deal with that shielding aspect a little bit better, and to do something about it, and not propose to do nothing as the IASB is currently doing. Over-optimism was a difficult one, I thought. Sue had a very interesting point, add some sensitivity analysis, but I can imagine that is commercially very sensitive for entities to publish their sensitivity analysis to justify the level of goodwill on the balance sheet. I mean, the competitors will be happy to take a look at that. I have the impression. Marisa said that auditors should be able to challenge the over-optimism. So it's a difficult one. I'm not clear about that myself, what to think about it. Indicator-only approach. I think that the panel was quite clear on that. Bad idea. Improve the test if possible, but don't cancel or don't introduce an indicator-only ID. The test is there. It's a good sign if the entities needs to do a quantitative test every year. It gives more comfort to the users that at least something has been done to check the book value, the carrying amount of the goodwill. However, that was not what the public said in the polling question. 37% said yes, introduce this indicator-only approach. However, 26% said no, don't do that. So in line with what the panel said. So let's say that the audience was rather mixed on that. Some would approve this indicator-only approach, others would not. And then, of course, there's the tremendous discussion on goodwill. Honestly, what I'm missing slightly in this debate is some conceptual thinking. And Wouter had a very interesting point. He said the value of goodwill could also go up or rise. And that's absolutely so. If your acquisition is successful, then you can sell it for a higher price. So you would have created extra internal goodwill. And that's a little bit of conceptual thinking I'm missing in the whole debate. You've got arguments in favor, you've got arguments against, but I think we should really try to think, not just look for a kind of easy solution, but try to understand what goodwill actually is and build on that. How we treat goodwill in the accounts, build on that conceptual thinking. Wouter had a very interesting point also. He said we should think about the reversal of goodwill impairment. I think that's a very valid point. If the value of something can go down, then the value of something can go up also. So probably something to take with us when we write our comment letters. Anything else? How do analysts deal with goodwill when analyzing companies? Most ignore the goodwill, doesn't matter, it's a non-cash item. I ignore the depreciations, but Steve said, no, hold on. He said, don't ignore the goodwill that is on the balance sheet because it's money invested on which the entity needs to earn a return. I'm fully with him there. It also refers to the stewardship aspect of financial statements. Analysts should try to understand that the entities are creating value, and for that you need to understand how much money they have invested in acquiring another entity. So all in all, I think quite an interesting debate, a lot of arguments that the audience and ourselves could take with us when finalizing our final comment letters. So that's for the time being for me, Hans.
Thank you very much. I think I'll give the floor back to Saskia. Saskia, you're on mute.
I thought I clicked it off. I was saying thank you very much, Sergio, for this summary. I think it was a brilliant summary flavored with your personal thoughts. We realized we left the most difficult task to you, not doing this myself, and I think you did a perfect job. I also would like to thank everybody who participated in this webinar. So Nick, Yara, Hans, Steve, Sue, Marisa, and Wouter. And of course, we want to thank as well on behalf of EFFAS the audience, which give us input in the polling questions and help us to develop our views. Last but not least, we want to mention, I said already, this is the 4th webinar, so we have more webinars to come. On the 24th, we have the Portuguese flavor for those interested, which might be very nice to see as well, the sort of more southern perspective on this theme. There are also webinars with the German standard setter and the Italian standard setter, but there you need to do a bigger effort because you have either to speak German or Italian and there is no translation. So they can all be found on the EFRAG website. So rest me to say very nice evening. Thanks everybody again and see you next time.
Thank you very, very much.
Bye-bye. Thank you.